Good.
All right, welcome everyone. Thanks for joining us. This is a good new topic that I don't think has been covered much before at one of these conferences, so I'm looking forward to this. So if we can start, and I'm going to get each of you to introduce yourselves and say whether you're on the liquidity provider side, the liquidity taker, or you're a lawyer. And there's one of each. So let's go. Martin.
Yes. Thank you, Sophie. So my name is Martin St-Hilaire. I'm Managing Director, Titan FX. So I am a liquidity taker from liquidity provider. But on the other hand, we are also providing liquidity to our retail clients. So we kind of figure out how the job of the liquidity provider, how it works. So this is.
Hi, my name's Andrew. So I work for IG Markets in their prime department. So we provide institutional liquidity to funds, other brokers. So we're a provider of liquidity, and we do also take liquidity as well, just for our own internal hedging purposes.
Cool. So I wanted to start with a practical question, which is around some of the terminology. Sorry, Astrid. That was so rude of me. I just know you so well that I knew the answers, so I moved on. Sorry.
No, all good, don't worry. Astrid Raetze from ABML Legal, and I'm the lawyer. So financial services and derivatives law.
Since I've cut you off, I'm going to ask you the question first. So there's a bunch of different terminology which gets used. So liquidity provider, prime broker, prime of prime. Can you tell us some of the practical differences between some of those terms? And I think Andrew will be able to chip in as well. So hopefully between the two.
I'm going to defer to Andrew on that one.
All right.
Okay, so I'll start with liquidity provider. So that is a firm which provides pricing for a financial instrument. So they'll give you a buy and sell price, and they will show you an amount that you can trade at those prices. So that is the liquidity that they are providing to you, and they're making a market. So for example, Aussie dollar price, here's my price to buy and sell. Prime broker, so that's a service offered by the investment banks. So they'll offer you their investment banking services, and also they will offer you their liquidity. So you can trade on their pricing, but they also allow you to execute with other market makers and banks as well. And using their infrastructure, you can trade on the interbank FX market and then have all those trades centralized to one account. So it's a very powerful setup. The third one, so prime of prime. So that came about because it can be hard to get a relationship with the investment banks. So some of the customers of the investment banks, what they did is they offered their access to the FX markets that they were getting through the investment banks directly to new startup firms, new retail brokers. So they're not a prime broker, they're a prime of prime broker.
Cool. And so what's the competitiveness of this space? Is it something that only a few people play in? Are there a lot of people in it? Andrew, you're offering liquidity. Do you feel it's competitive?
Yeah, super competitive. So I think you can see here with all the providers offering liquidity, it's a super competitive market, well-established market, but I think there's still opportunities available for new entrants, but I think you just kind of have to find a little bit of a niche. So if it is something you're looking to get involved in, let's say you're a retail broker, you want to get into the wholesale space, just kind of copying the existing providers. There's tight margins at the moment, so it's not a market where you can just jump in and get fat profits. You'd probably have to think about a little bit of a niche, potentially how you onboard clients or technology or a new product, like become a specialist in crypto, or the way you provide the price. If you can find that differentiator, then that's where you could potentially enter that market.
Is it something that you're thinking of, Martin? Are you looking down that path, or you want to stick to the retail liquidity?
No, we're not looking at becoming at providing liquidity to others. We've been asked a few times. We've studied that possibility. However, about every week, three times per week, I would say, in my inbox, in my LinkedIn account or my inbox, I have like people that wants to talk to me about like liquidity. We can be better. We can beat the other one. And from time to time, we do like some of them. They do like. Attract some attention, let's say, and I will actually direct it to different people within my organization to look like closer to the offering. But I would say that it's really difficult. I feel like, from my point of view, it's so competitive that it's really difficult to actually get some volume. You need to push another that is there. And a lot of that business is based on trust, is based on loyalty, it's based on the long-term relation. And us at TitanFX, we value a lot these things for our client and for all our supplier. So we try to work with people that we know that they will answer the call when it's going to be difficult, because doing the business when everything goes smoothly, it's easy. So price is one aspect, but it's not the only one. So that make it like really difficult for someone new to enter that market, I would say.
And so when you get these requests in your inbox, and if they're lucky enough to catch your attention, which department of your business would you push them to? Are they going to your technology team? Do you have a dedicated team? Is it sales? Can you give us an insight?
It will go to us. We have a chief trading officer, so that is within the operation team. So that operation team is spread worldwide within, like, I think we have people in 8 different countries, because we want to cover 24/7 with that team. So they are the one that are the closest to that deal with our. We have about maybe 6 liquidity providers these days. We have a few is we need redundancy on each product, plus we have certain ones that are better on certain product, while other are better on other product in terms of their pricing. I agree with Andrew that someone that wants to come in, and that's how we have added in the past year. New one is, let's say we want to do CFDs on the crypto, then we added someone else that was not the main one that we had as a legacy of the company. So then there's a niche.
And Martin mentioned he has 6. Andrew, do you see yourself like in a panel with 10 different liquidity providers? Is 6 a lot, a little? Where do you tend to see it?
I think 6 is quite a bit, but I think, as Martin pointed out, that's probably because his firm offers so many different products that they have to fill niches for their clients. So those 6, I'd imagine, are not all competing for the same products. Maybe they are, but yeah, I would say most clients definitely have, 3 to 4 is kind of a good amount where you've got enough business to keep your liquidity provider satisfied in terms of volume, unless you are doing a lot of different assets like Martin, and you need to split it out because your provider cannot give you that asset class, then it makes sense to go to like the 6 or more level.
Okay, and so when you get to the point where you've got someone's attention to give them liquidity, and you go to the point of sending them an agreement to get that started, just on a practical level, do you have a legal team that sends it out? Is it a master agreement, or do you have a more customized template going from IG?
So for us, we have our own direct agreements, which fairly standardized market agreements. So we don't typically get clients coming back saying, I'm surprised by this clause or anything of that nature. And we just negotiate directly with the client. If something comes up from a legal perspective, I would then refer that to our kind of internal legal team to discuss if we can make any adjustments to the contract.
Okay. And so, Astrid, if you were on the receiving end of a liquidity agreement, what would you be telling your client to be taking a good look at?
Well, there are a number of areas to consider, and it also depends in part on your negotiating power, which often, if you're a receiver of the agreement, is not very high because you're starting out, or so a lot of the time you're taking the terms that they give you. But having said that, there are a number of areas where you can chip away And then in those areas where you don't get any traction and you can't amend the clause, my advice is always to make sure you park it, monitor it, and as your size grows, revisit and renegotiate. So of all of the things that I have a look at when I look at a prime brokerage or an ISDA agreement, I picked out 4 to kind of highlight for you today. The first one is segregation of assets and money. So you need to understand whether or not your assets and your money are being segregated by your counterparty. Now, that can be jurisdiction specific. So in Australia, for example, you would have segregation of client assets and money, but in the US, you're not automatically going to get segregation. So you have to check where are your assets and where's your cash being held, and is it being properly segregated from the prime broker's own assets and cash. The second thing you want to then check is whether your assets and cash is being commingled with other clients, and it often is. You're often held in an omnibus account. If you are big and bad enough, you can insist on having your cash and your assets segregated both from prime broker and other clients. But in my almost 30 years of practice, I think I've seen that happen twice, and your fees will go up if you do manage to negotiate that. Now, if you are in a commingled omnibus account with other clients, then you also need to understand what are the top-up obligations in the jurisdiction that you're in. So if a different client becomes insolvent or defaults on a payment, then the prime broker will draw from the assets or the cash out of the omnibus account. So what are the obligations on that prime broker to top up that account, and how long have they got to top it up? Right, so if they have, say, 48 hours to top up an account and they go insolvent in those 48 hours, then that client seg account is below where it needs to be from an asset or a cash perspective, right? And you end up exposed with credit exposure. So that's my point 1. Point 2 is check who you are actually dealing with. Like, what entity are you signing up with? Because often there'll be a counterparty on the agreement, but when you actually look at all the definitions, it pulls all of the group companies in. And what you will find is that if you are holding assets with a custodian, which is a subsidiary of the group, those assets held by the custodian are able to be either merged with or taken by your prime broker in order to settle any monies that you owe or liabilities that you owe. So you will find that any member of the group that you hold assets with or that you have a transaction with has access to your cash and your assets. And so that's worth checking and being aware of. The third thing is make sure you understand rehypothecation. So rehypothecation is a thing that started creeping into prime brokerage agreements around GFC time, so a while ago now. And basically what it means is that the prime broker has the right to take an absolute transfer of any of your assets or cash at any point in time that it feels like, for any purpose that it wants. And what it means is that if it does that, it then has a contractual obligation back to you to repay. Obviously, that means you've got credit exposure to the prime broker because they've just taken your assets, and all you have is a contractual obligation by them to repay an equivalent value of the assets that they've taken. Rehypothecation clauses are really difficult to negotiate out of an agreement. It is possible. Again, your fees will go up if you negotiate it out. And again, I have maybe seen that happen twice since GFC. So really difficult. But it is something to be aware of and to monitor, because the rehypothecation clause is different from your collateral that you've posted. Most collateral that you post is also an absolute transfer, and you also have credit exposure on the prime brokerage on your collateral that you've posted. Point number 4 is check your events of default, and in particular your consequences of events of default. And in this case, it is more around when is the prime broker defaulting. So you'll normally have insolvency in there, but you also want other things in there, like if they breach their obligations, if they fail to pay, and misrepresentation. You want some of those events of default in there. And then most importantly, the consequences of an event of default, and in particular insolvency. So there's two key points there. One is make sure they're not cherry picking the transactions on closeout. So all the transactions get closed out and you get a liquidation or a closeout amount. Cherry picking is when they take only the transactions where you owe them money and they leave open the transactions where they owe you money. So you want to make sure that clause is not in your documentation. And the second one is that you have the right to appoint a calculation agent if the prime broker has gone insolvent. Those rights were not in a lot of the agreements during the GFC, and it meant that you were having to wait until the receiver got around to calculating what the positions were, and the positions would deteriorate over time. So make sure, and usually you can actually get that clause in. So you can actually negotiate that one with success, because the counterparty recognises that if they're insolvent, you need to get your assets out, and so they'll normally agree to that clause, but they won't volunteer it. You have to request it. They'd be my 4 top tips.
I would definitely have you negotiating an LP agreement for me if I was on the receiving end. I thought the one about entities was really interesting, especially in this space where we have a lot of brokers with lots of different entities in different countries that have different ramifications and different legal systems. I'd be interested to hear from you, Martin and Andrew, about what you're seeing in terms of entities. Are there countries that you'd prefer to deal with? Are there countries you say no to where you've been offered liquidity from, or you don't want to offer liquidity to? I don't want to put you on the spot, but it'd be good to hear your thoughts on that.
Sure. Yeah, look, we definitely have a list of countries that we can and can't deal with. So ideally, it's centres where there's CFD and FX regulation, ASIC, in Australia, UK, Singapore. Those are kind of our key markets where we have offices as well. In saying that, we do also look at offshore centres as well, because there is a lot of business happening offshore, so you can't really ignore it. It might just be the requirements, the documentation, the onboarding process is a little bit more thorough for those clients, and the requirements that we have to get our liquidity is a little bit of a higher barrier.
Is your pricing and your collateral requirements different in those countries?
It's unfortunately it's not, no, because it is so competitive. I guess it's a buyer's market when it comes to the liquidity at the moment. There's a lot of competition. So if we were to go in with a higher price, I think we would price ourselves out of the market. It's just about getting comfort with with each other in terms of which entity we can onboard the client to within the IG group and which entity we are facing as well. Okay.
Martin, do you have any thoughts on that?
Yes, on that topic, let's say we have a non-discriminatory position. Let's say we don't like to discriminate like organization, people solely based on jurisdiction where they operate. We feel like it's a bit unfair that there is good and bad apple in every jurisdiction actually, so you need to look behind the jurisdiction as long as it's legally compliant. And we talk about over-the-counter like product here. We don't talk about like everybody knows that it's a short-term, high leverage, really risky investment that the client are taking, and that's the liquidity that is provided exactly for that product. So I would say that from my point of view, no liquidity provider said to us, guys, you are headquartered in Vanuatu where we don't want to talk to you. It did not happen.
That's good. I'm sure they just want to come and visit you as well. It'd be really nice to come and have a look at the Vanuatu office. So I guess another point, because I work in transaction reporting, I have an interest in some of the concepts around that. So do you ever see requests from brokers to have their reporting delegated to you as part of a liquidity provision agreement, or you're not seeing any reporting implications coming through? For example, there's the delegated reporting, there's the unique transaction identifier, there's the unique product identifier. This is all coming through in the most recent reporting rewrites. Is that something that's feeding through in relationships that you're having?
I guess in terms of the data that we're providing to the client, so it's become more important so they can meet their obligations. Not so much delegating the reporting to us, but they will have an expectation that we can provide them with timely data, with the unique numbers that you mentioned on the trades as well, so then they can conduct their own reporting. I guess as well they'd have multiple liquidity providers, so they wouldn't just rely on IG. They'd be collecting that data from a couple of sources and then grouping that all together for their own reporting.
Yeah, and in terms of the sort of technicalities and operational side of things, are you bridge provider agnostic? Do you go through multiple bridges? How do you both see the bridge market? Because that really feeds into the liquidity space as well.
So we're agnostic. That's up to the client to decide which bridge best fits them from cost and the service that they can provide. We're happy to integrate with any bridges that are in the audience, so happy to chat. So we don't get involved in that side. We just make sure that we have that relationship with the bridge company. We work with them to do the integration. We've got a specialised team that does that on behalf of the client, so they get our liquidity and they get the best execution possible.
The bridge is, let's say that it's a business that seems a bit less transparent than the liquidity provider. So I would love a panel that is negotiating for a favorable term with your bridge. Because with the bridge, it's most of the broker I know, they work with one bridge. It's so it's a single point of failure if that bridge is not working. I hear more and more than people are searching to have like maybe a redundancy there, so they are having two bridge. But the bridge is so key that you want it to work all the time. There's no like fallback if that thing breaks. So, but on the context of the liquidity provider, so far the bridge that we use accommodate every like liquidity provider that we use. Let's say that it works.
So what's the legal implications, Astrid, if a liquidity provider stops providing prices? Have you seen, or like there's a CrowdStrike issue, the liquidity provider goes down, whether it's directly or through the bridge? What's the legal benefits that you can
Depends
pursue?
on what caused it.
Okay.
So, well, it can run the gamut from a force majeure event, in which case everything is just suspended until it starts up again. It can be a default, in which case the default provisions get triggered. Most often I would expect it to be a delay around. There are often clauses in the prime brokerage agreements that if a payment hasn't been made because of administrative error or because software is down, then you get a grace period. So my expectation is it would be along those lines unless it is a default.
And then would you be saying that you'd be sending them a punchy letter, or would you be trying to have a more commercial negotiation?
Yeah, you would find out what's underlying the problem first, because if it is just a software issue or an administrative error or something like that, then you're just going to have to sit tight and wait. And then you'd probably be wanting to negotiate whether or not they'll make you whole, assuming you've lost money as a result, which, depending on the clauses in your prime brokerage agreement, is unlikely. But I wouldn't be sending a punchy letter as my first go-to, no.
Okay, well, a nice conciliatory lawyer there, which is good. And I won't ask Andrew if their pricing has ever gone down, because I'm sure it hasn't. So, but it'd be good to hear more about the pricing strategies that you talked about before, and the minimum volumes, especially for sort of people who are new to the market, to find out what do minimum volumes look like? Is that common? How do people providing liquidity charge?
I guess probably the first thing I'd look at if you were a client is find out where your counterparty sits. So are they a liquidity provider, or are they prime broker or prime of prime? And so that will help you kind of work out what the discussion points are. Because if I go to a prime of prime who is passing on someone else's price and adding commissions and ticket fees, well, it's hard to negotiate on the price you're getting because they're passing through someone else's price. But you can certainly look at, you know, the ticket fees and the commissions that they are adding on top, or their services. That is your kind of negotiation point. For a direct liquidity relationship, well, they're offering you their price. So the price you're seeing, the consistency, the amount that you could trade at that price, those are the things you can negotiate with a liquidity provider. In terms of minimums, I guess it's up to the market, it's up to the prime broker or the liquidity provider. I don't think there's kind of a standard. Some will come in with no minimums to kind of try and win your business initially, and then maybe try and renegotiate. I imagine you've seen that before. We kind of certainly go in with an upfront, transparent position. We'll say, well, look, we have a minimum expectation. We don't just want to be a price provider. We expect business to come through. I think that's fair and reasonable. We try and show the client what that is. It depends, again, what they want to trade with us. And, you know, then it's up to them to accept or negotiate.
And are your minimums, are they averages across, say, a 12-month period, or do they have to hit a minimum every month? Because I can imagine some months are bigger than others for some brokers.
Yeah, that's a really good point. So, because the market will just dictate with the volatility. So we generally would have like a lead-up time, you know, allow clients to integrate, get going. It might be a new product they start marketing. And yes, we will have minimum monthly volume expectations, but that would be weighted over an extended period. So we won't be looking at it every month going, you're not hitting it, you are hitting it. It's kind of an average over, you know, 3 to 6 month period. And then it's also a discussion. You know, we have relationship managers that you can talk to about plans. It's not a hard and fast rule as such.
Okay, and so we're coming towards the end of the panel, but I just wanted to find out from you, Martin, are you the chief negotiator on your LP agreements, or you're passing that off to your legal or technology teams?
Definitely, I'm passing it off to the other one.
Okay, but you take on the relationships and the lunch with the LPs once it's done?
Exactly, I keep the good stuff on my side, or part of it. But for a reason, because, you know, it's a really, really important relation, because it was really nice to hear Astrid about it. She seems to be like on top of her game, and I'm impressed. Well done. But we aim to not see that happen. So we aim, it's like a wedding. You aim to not go to divorce, let's say. So you need to have good like LP that you can trust, and, you know, if shit hit the fan, it's good if you have a relation before, because you're not going to be the last one to know, or you might smell it before, or so it's for us. It's all about like maintaining like close relation with our. We believe it's the best way to protect or prevent, let's say, the risk.
Okay, and you're not taking your legal person with you, so Astrid won't get to go to the lunch with you.
No, yes, we are actually. I have about 20 staff that
go.
came to that conference here from different places in the world. So we are bringing a lot of staff in, and we try to expose them as much as possible as well.
Okay, perfect. But Astrid, you would add the lunch to your bill by the sounds of it. So you just want to stick to the negotiation side of things.
Yeah, no lunches for us on this side. No.
Okay. Any closing points before the end of the panel on LP agreements that you just want to throw in?
My main point is make sure you understand what your risks are and monitor them. And in particular, as your negotiating size improves, go back and renegotiate them. Because if you become bigger and badder, they will renegotiate some of those terms with you.
Yeah, I would agree with that. Read it. As a lawyer, my advice to clients is always actually read the document. We have a lot of experience where people haven't read the document, and yeah, it is, as you get bigger, the document has a lot more value and can go a lot more wrong. So make sure you've read the document and go back at the end of today's panel and take a look at those clauses that Astrid pointed out. And Andrew, any final points from you? No, you've given us some good points to take away, so appreciate that. So thanks everyone for coming. Hope you learnt something new. I hope you're going back to dig out your liquidity agreements, and you know where to come to with any of us on the panel if you need anything further. Thank you.